What should people know about risk exposures and impact investing? Well, there's currently a pretty contentious debate about whether there is a trade-off between financial return and social impact. So what people will often do is compare the raw returns of impact funds to those of traditional non-impact private market funds. But that misses a crucial point, which is that without accounting for risk, this comparison it's just incomplete. And our research shows that once you appropriately adjust for market risk exposure, impact funds are just as competitive as non-impact funds, at least in terms of risk-adjusted financial performance. We think that this is important for investors because we're really trying to shift the narrative about the financial performance of impact investing funds. So traditional metrics in private markets don't typically account for risk. And this is really just because it's quite difficult to find an appropriate market benchmark for these assets. But risk is crucial. And the main finding of our paper is that impact funds have much lower systematic risk exposure than other similar non-impact funds. So what this means for investors is that adding impact investing to a diversified portfolio may actually lower overall systematic risk exposure, in addition to helping investors achieve any kind of social or environmental goals they have. So not only is our paper showing that appropriately accounting for risk demonstrates that the risk-adjusted returns between impact and non-impact are quite similar, but there is a broader role for impact funds to play in investor portfolios.